On Inside Track this week, Stuart Halper, co-owner of Impact Real Estate Management, talks about the financial challenges caused by land leases that are terminating sooner rather than later.
About a year ago, one of our large properties, a 160-unit cooperative in Queens that was formed in 1956 under Section 213 of the federal housing law, its loan was coming due with NCB. It was a 10-year note, $2.5 million, 30-year amortization. Now, the interesting thing about this property is that there's a land lease. The cooperative does not own the land underneath the property. There's a landowner and has leased the property back to the cooperative since 1956. It was a 99-year lease. It expires roughly in 2055 or 2056. We needed to go out and we needed to refinance the note that was coming due. And we ran into a buzzsaw in that we've always spoken about the risk of cooperatives that have this underlying lease that's coming due either in X amount of years, most of them in the 50s, and it finally came home. And we ran into resistance from the banks in trying to do the standard cooperative loan, 5 or 10-year note with a 30 or 40-year amortization so that they virtually paid no principal and virtually we wanted to pay interest only to keep the costs down. And that's the way, as everybody knows, most cooperatives work. Well, when we went to refinance it, we found resistance in that there wasn't many banks that were willing to get involved in this co-op because of the underlying lease and the near termination, even though in 2055, most of the board members, including myself, we don't expect to be here. We thought long and hard and we did what we had to do, and we got into some serious negotiations with various different banking institutions, and the current lien holder, which was NCB, decided that they would get involved with us and that the cooperative was still viable despite this. Before, though, we actually went down the path of refinancing, we also had the idea of reaching out to the landowner and to say, okay, what would you like for the property? We could borrow money at this time, we could go into the market, shouldn't be a problem, and we could solve all of this. I mean, since 1956, we've been paying about $2,000 a year in rent. They have not received much compensation for it. After a number of phone calls and going back and forth with the owner, the answer was no, it's going to be an annuity for future generations to deal with. Because like myself, he was not going to be here as well too. So now we were presented with refinancing. What happened was NCB actually came back to us and proposed doing a 25-year loan fully amortized. So what does that mean? That means this is going to be the last loan on the building. And we needed to anticipate all of the work that's going to be done in the next 25 years because we're not going to be able to go back into the market more than likely to borrow additional funds. It's hard now, it's only going to get harder later on. So we had to put our thinking caps on, bring in our engineers, contemplate 5 more local law 11 jobs, since it runs in a 5-year cycle, the modernization of the elevators, which hadn't been done since God knows when, and a host of other issues, also the conversion of the boiler system from burning number 2 to gas to achieve some savings. So we decided that we'd have to increase the loan amount to pay off the 2.5 plus borrow an additional $2.5 million for a $5 million loan. Now, what's the consequence of that? Now it's a 25-year loan, fully amortized, which means from the beginning, you're starting to pay principal. All of that principal, the $5 million, has to be paid over the 25 years. At the end, NCB wanted to be owed nothing. So we had to scratch our heads and say, okay, this is an affordable place. One of the interesting things about the 213s is that the maintenance levels tend to be a bit less than the regular market cooperatives. The big decision was now we have to increase maintenance to cover the increased principal payments. It hurts because number one, it's not a deduction, it's not interest. And the bottom line was, it went up about $200 on average, the carrying cost to cover this loan, whether we use the money or not. And we're going to have to hold a good chunk of this money in a bank account until we use it. What happens when the lease expires? A lot of uncertainty. Is the government going to step in and help these individuals? Does it revert back to a rent-stabilized or rent-controlled building back from the prices in 1956? We don't know. We don't know the end game. And we have to deal with the intermediary steps now. And all of these 213s now, if they're going into the market to borrow money, are going to face the similar situations that we faced. You need to start early. That's the key ingredient, because you got to put all of the pieces. It's not like a regular refi where you're only going out 5 or 10 years. You're looking out 25 years. You got to start early. That's the big lesson that we've learned.